Hey everyone, welcome back to The Explainer. Today, we're diving deep, and I mean really deep, into the source material to figure out what is actually happening inside your retirement accounts. Look, we pour our hard-earned money into these accounts, right? We trust the system to build our future. But when you really start digging into the data, the academic research, and especially the fine print, a much more complicated picture emerges. So today, we're going to unpack the whole thing. So is your 401k ripping you off? Yeah, it's a bold question for sure. But this isn't just some provocative thought experiment. It's a very real concern being raised right now by financial researchers and legal scholars. For millions of us, the 401k is the absolute primary engine for building wealth. But as you'll see from the data we're looking at today, what you don't know about your account could literally be costing you a huge chunk of your life savings.
Okay, let's dive into this. Here's our roadmap for today. First, we'll hit the 401k and IRA basics. Then, we'll look at the hidden fee problem, what dominated funds actually are, the fiduciary duty loophole, and finally, how to protect your retirement.
Part 1, 401k versus IRA basics, understanding the options.
When you look at the structure of these accounts, the differences really pop out. A 401k is employer-sponsored. That means your boss sets the whole thing up, they pick the menu of investments, and the money comes right out of your paycheck. The biggest part here, the employer match. If your company offers a match, your absolute priority should be grabbing every single dollar of it. It's effectively free money, and turning down free money is basically a financial cardinal sin. Now, 401ks also give you higher annual contribution limits. On the flip side, you have the individual retirement account, or IRA. You set this one up yourself. And while it does have lower contribution limits and zero employer match, it gives you incredible flexibility and a massive universe of investment choices, rather than just that tiny restricted menu your boss picked out.
Another quick basic concept is how these accounts are taxed. You've basically got two flavors, traditional and Roth. With a traditional setup, you put in pre-tax dollars now, which shrinks your current tax bill, but you pay taxes later when you take the money out. Roth accounts flip that completely. You pay the taxes up front with after-tax dollars, but your withdrawals and retirement are totally tax-free. Both of these offer incredible advantages to help your money grow, but the research is super clear on one vital rule. No tax trick in the world can ever make up for lost time and compounding growth. You just have to stay invested.
Moving on to part 2, the hidden fee problem, what you aren't seeing.
Check this out. According to a survey by AARP, 7 out of 10 workers pumping money into a 401k think they pay absolutely zero fees. None. Zilch. Even with newer fee disclosure rules, the vast majority of folks are completely in the dark about what it actually costs to manage their money. But just because you don't hand over a cash commission when you buy a mutual fund inside your 401k does not mean it's free.
Now, what's really interesting here is how these invisible costs break down. A finance professor at UC Davis looked at nearly 1,800 funds and found that we're really only seeing half the picture. The first slice of the fee pie is the fund's operating expenses, which average around 1.31% for U.S. large-cap stocks. But that second slice? That's the transaction cost, averaging 1.44%. You smash those together, and these hidden fees can eat up almost 3% of your returns every single year. To put that into perspective, sure, operating expenses cover things like the fund manager's salary, record keeping, and compliance. You can usually hunt those down in a really dense fee disclosure document. But those transaction costs, those happen behind the scenes when the fund itself is out there buying and selling securities. You won't find those listed in any prospectus. They are completely invisible to the everyday investor, yet they act like a slow, silent leak in your retirement boat, just draining your wealth year after year.
Section 3. What are dominated funds? High-cost traps.
To really unpack this, we're drawing on a massive study published in the Yale Law Journal by professors Ian Ayers and Quinn Curtis. We're talking data from over 3,500 401k plans holding north of $120 billion. Their objective research reveals a really startling reality. A huge chunk of 401k plans are actually built with menus that predictably lead regular investors right into excessively high-cost portfolios.
And one of their wildest findings is the presence of something they call dominated funds. What is that? Well, it's a menu option that basically adds zero value to your portfolio, an optimal weight of less than 1%. Yet it charges over 50 basis points more in fees than comparable stuff out in the broader market. In plain English, these are high-cost traps. They offer you absolutely no diversification benefits, but they charge exorbitant fees. And incredibly, the Yale study found that more than half of all the plans they analyzed offered at least one of these dominated funds.
And here is exactly why these traps work so well. It all boils down to human psychology. A lot of everyday investors use what researchers call a naive diversification strategy. They look at the dozen or so options on their 401k menu, and just to be safe, they spread their money evenly across all of them. It's exactly like going to an all-you-can-eat buffet and putting a little scoop of literally every single dish on your plate, even the terrible ones. By doing this, well-meaning people walk straight into these high-cost-dominated fund traps and totally sabotage their own returns.
So, what's the actual damage here? Because of these traps, restricted menus, and poor choices, the Yale researchers calculated the true cost of this system. They found that investors in an average 401k plan are paying 78 basis points more, nearly 0.8%, than if they had just bought standard low-cost retail index funds. In fact, in 16% of the plans they analyzed, the fees were so insanely high that they completely wiped out the tax benefits of investing in a 401k for a young employee. Crazy, right? Part 4. The fiduciary duty loophole. The large menu defense. Now, you might be wondering, isn't there a law against this? Well, by law, plan sponsors, your employers, do have a fiduciary duty to look out for your best interests. But there's a massive legal loophole called the large menu defense. When employers get sued over excessive fees, they just point out that they offered a big, diverse menu of choices, and the courts have largely agreed with them. They focus on the process of providing options, not whether the fees on individual funds are actually reasonable. So as long as a plan tosses in a few good, low-cost options, courts generally let sponsors totally off the hook for keeping those terrible high-fee traps on the exact same menu.
Finally, Section 5. Protecting your retirement. Take control today.
So the crucial point is, what can you actually do about all this right now? Well, the sources lay out a few immediate moves. First, check if your plan allows for an in-service withdrawal. This lets you move a chunk of your 401k straight into your own self-directed IRA, where you call the shots and can pick lower-cost alternatives. Second, if your plan offers a self-directed brokerage window, use it. Use it to buy low-cost exchange-traded funds, or ETFs, instead of those pricey mutual funds. And third, anytime you change jobs, you really need to consider rolling that old 401k into an IRA so you can escape those restricted menus and high admin fees for good.
But, relying entirely on individuals to dodge these traps isn't really a long-term fix. The system itself needs an overhaul. Fortunately, the Yale study proposes 3 big structural reforms. First, they say we need to mandate universal, low-cost default investment options. Since a lot of people never actively change their investments, the default just has to be cheap and safe. Second, if a 401k is officially designated as high cost, employees should be allowed to roll their money out of it penalty-free anytime they want. And third, I find this one fascinating. They suggest requiring a basic financial literacy test before an investor is allowed to opt out of that low-cost default. It sounds kind of strict, right? But it's actually an educational barrier designed specifically to protect everyday savers from accidentally walking right into those high-fee traps. Man, we have covered a lot of ground today, from the absolute necessity of grabbing that employer match, right down to the hidden 3% fee drains and the shady legal loopholes keeping those dominated funds in your portfolio. I want to leave you with one final, crucial question to chew on. Your 401k undoubtedly saves you on taxes today, but how much time and wealth are hidden fees secretly stealing from your future? Take a really close look at your own plan's disclosures, question the fees, and take control of your financial health. Keep learning, keep questioning, and I'll catch you in our next explainer.